Welcome back to the Deep Dive. Today, we're diving headfirst into, well, the pretty fascinating and, let's be honest, often turbulent world of Stellantis NV. That's ticker STLA. Now, if you've been keeping an eye on the markets, you know this automotive giant is at a real crossroads, a pivotal moment. Some might even say precarious. Our mission today, got through all that noise, the conflicting headlines, the stock swings, get right under the hood and figure out what's really going on with Stellantis.
And there's definitely a lot to unpack. Stellantis' stock, it's been all over the place, wildly volatile. And the stories around it are pulling in completely opposite directions. Is it this hidden gem, undervalued, ready for a big comeback? Or is it a classic value trap? The type looks cheap, lures you in, but just keeps falling. Yeah. It's complex. So, we're going to break down all the critical pieces for you today.
Absolutely. We want to arm you with the facts, the surprising ones too, the key numbers, and the insights you really need to make sense of this company. So, okay, let's set the scene. Where does Stellantis stand right now?
Well, this stock has taken a real beating lately. Over the past year, the price is down around 56%. That's huge. And its price-to-earnings ratio, the PE, it's kind of languishing below 5x. We're talking a 70% collapse in net profit for fiscal 2024. Ouch, it's definitely been painful if you're a shareholder. But then, just recently, June 25th, 2025, something pretty significant happened. Jefferies, the research firm, they upgraded the stock, went from hold right up to buy. And they didn't just nudge the price target, they seriously hiked it. For the NYSE shares, it's now $13.20. That implies, over 37% upside from where it closed?
Yeah, that Jefferies call, it wasn't just another analyst note. It felt like a real potential shift in the narrative. Their core argument is really interesting, Stellantis' problems. They're saying they're self-inflicted and fixable. Basically, the message is, look, this deep discount isn't because of some huge unstoppable market force. It's internal stuff they can actually solve. They point to things like needing to make some overdue decisions, getting past product launch delays, especially over in Europe, and making progress on what they call the painful destocking in North America.
Painful destocking?
Yeah.
Meaning getting rid of too many unsold cars sitting on dealer lots.
Exactly. It hurts revenue in the short term, obviously, but it's absolutely essential to clear that backlog, get the inventory healthy again, and make room for the right cars people actually want. That's really the engine behind their bullish bet, the idea that management can fix these things.
Okay, that's a strong take. But let's push back a bit. Is Jefferies kind of out on a limb here? Because the broader analyst community, they seem mostly stuck on hold. Average ratings like 2.8 from 10 firms. And we've seen downgrades pretty recently too, right? UBS, Redburn Atlantic, Piper Sandler, all in the last few months. So is Jefferies seeing something everyone else is missing? Or are they maybe jumping the gun a little?
That's a really fair question. You're right. Most of Wall Street is basically in a show-me mode. They want to see the proof, actual tangible improvements before they fully buy in. That 2.8 rating, that screams wait and see. They'll want to see better operational numbers quarter after quarter.
Right. But despite that caution from most analysts, the market itself reacted pretty fast, didn't it, to that Jefferies upgrade?
It did, yeah. Shares popped more than 3%.
In both the U.S. and Europe.
Exactly. Which, it tells you investors are at least open to the idea of a turnaround, even if the analysts need more convincing.
So if the problems are self-inflicted and fixable, who's the fixer? This brings us to maybe the biggest potential catalyst here, the new guy in charge, Antonio Filosa. Took over as CEO June 23rd, 2025, after a, 6-month search? Seems like a clear break from the past CEO, Carlos Tavares.
Yeah, and what's key about Filosa is his history. He's not an outsider. He's a 25-year company veteran. Seriously, worked his way up, COO for the Americas, global chief quality officer, ran the Jeep brand, and importantly, he gets credit for turning around Fiat and Jeep down in South America. That region's actually been a consistent bright spot for Stellantis, so he knows this company inside and out.
Okay, deep insider knowledge. And his style sounds very different from Tavares, who had that reputation for aggressive cost-cutting, maybe a bit authoritarian, reportedly didn't make friends with dealers or unions. Filosa is described as more hands-on, approachable, collaborative. But can a long-term insider, someone so embedded, really be the radical change agent they might need? Or does that deep history maybe risk, keeping some old habits alive?
That is the billion-dollar question, isn't it? And the market, it wasn't immediately sold. The stock actually dropped about 10% right after he was appointed. Some investors were clearly hoping for someone completely external. But Filosa, to his credit, he definitely hit the ground running. His first moves suggest he gets the challenges. Day one, streamline the top leadership, cut direct reports from 33 down to 16. That's significant. And maybe, most crucially, he decided to keep his old job too, head of North America and the American brands.
Wow. Okay, so CEO and running North America directly.
Yeah, it's not just symbolic. It's a massive signal. He's putting himself personally in charge of fixing their biggest, most troubled market.
It's a bold move. Takes guts.
It is, but it also creates what analysts call key person risk. Sure, it means intense focus on North America's problems, but does it mean he can effectively run the entire global company if so much energy is focused there? That's definitely something for you, the listener, to watch. How does he balance that?
All right, let's shift gears a bit. Talk about Stellantis' assets. And maybe its biggest challenge, too. That huge portfolio. 14 brands. We're talking icons, right? Jeep, Ram, Dodge. Huge names.
Yeah.
But managing all that must be incredibly complex, a real double-edged sword.
And that complexity feeds right into the undervaluation argument we touched on earlier. That PE ratio stuck down in the 3x, 5x range. I mean, compare that to Ford, which is traded up over 14x PE. And here's a comparison that just, well, it kind of blows your mind sometimes. You can see a company like Carvana.
The online used car retailer.
Yeah, they don't make anything. And sometimes their market value, their PE ratio, which has been over 110x, is higher than Stellantis, a global industrial powerhouse. It just doesn't compute.
Yeah.
Especially when you look at Stellantis' fundamentals. They had nearly 50 billion euros in liquidity, more cash than debt, made 5.5 billion euro profit last year. It's a screaming signal that the market is overlooking some serious strengths, likely due to these perception issues. Makes it a potential deep value play if they fix the narrative.
That Carvana comparison really drives it home. And it connects to a massive problem. Poor brand management recognition and, frankly, terrible dealer relations. You mentioned a survey. Kerrigan Advisors found Chrysler, Dodge, Jeep, Ram dealers ranked them dead last in trust. 72% said no trust.
Yeah, 72% no trust.
When your own dealers, the people selling your cars, feel that way, I mean, that's a 5-alarm fire, isn't it? Makes you wonder how much business is lost before a customer even walks in.
It's definitely alarming, but there are maybe some green shoots. Early signs of a potential turnaround in perception. For example, the Jeep Gladiator actually ranked first in its segment in the latest J.D. Power initial quality study. That's a solid objective win for that specific product. And they are trying new marketing pushes. Jeep's got that tie-in with the new Jurassic World movie. Ram's got their Nothing Stops Ram campaign. Plus, there's a lot of buzz, strong sentiment about bringing back beloved names like the midsize Dakota pickup and definitely the Jeep Cherokee. That could really help rebuild dealer confidence and customer interest.
Okay, bring you back classics. And what about that other angle, the investment in Leapmotor, the Chinese EV maker? Seems like something the market isn't paying much attention to.
Yeah, it feels overlooked. Stellantis has a 21% stake, but more importantly, they control 51% of the joint venture, Leapmotor International. This gives them exclusive rights to sell Leapmotor vehicles outside China.
So leverage Chinese tech and cost structure, but sell globally.
Exactly. It's a really pragmatic way to get into the affordable EV game without, pouring billions into developing it all from scratch themselves. It's lower cost, it's capital light, it lets them compete in that crucial segment while avoiding the absolute dogfight within the Chinese domestic market. Pretty smart, potentially.
Interesting. And beyond Leapmotor, it seems like they're placing bets elsewhere, too, trying to de-risk things through partnerships.
Precisely. They're spreading their bets. Look at Archer Aviation. That's a big bet on urban air mobility. Flying taxis, basically. EV teals. Stellantis isn't just passively investing, though they've put in over $165 million for almost 12% ownership. They're also the manufacturing partner, committing up to $400 million in support. It's cutting edge. High risk, sure, but potentially high reward.
Okay, flying taxis, that sounds cool, very sci-fi. But hang on, given the quality issues we've heard about in their core business, cars and trucks, isn't there a risk they're getting distracted, spreading themselves too thin trying to build flying machines before fixing the Jeeps?
That's a totally valid concern, and it speaks to the execution risk we mentioned. It's a balancing act, right?
Yeah.
Future-proofing versus fixing the present. But they're also looking at core tech. They're involved with Ideal Power, evaluating their B-TRAN semiconductor tech. Think of B-TRAN like a super-efficient power chip for EVs. Could really boost range and performance. And it's not just lab stuff. A Tier 1 supplier is already asking for quotes for millions of related modules. So there's real commercial intent there, a quiet potential edge.
So strategic tech bets. What else?
Well, they've shown some flexibility. They wound down that smart cockpit venture with Amazon, pivoted to using Google's Android Automotive OS instead. Seems more practical. And they're shoring up battery supply with the Nextstar Energy Gigafactory JV with LG in Canada, plus a long-term deal to supply electric vans to Iveco. It paints a picture of a company trying to navigate a really complex, fast-changing landscape on, well, multiple fronts at once.
Okay, so lots of internal maneuvering. But what about the big stuff happening outside the company? The external forces they can't really control.
Ah, yes. And the biggest one, the elephant in the room, is definitely the tariff overhang. The potential impact of steep U.S. tariffs. We're talking 50% on steel aluminum, 25% on cars and parts. It's huge. Billions of dollars in potential costs. Ford's talking maybe a $1.5 to $2.5 billion hit. GM, maybe $4 to $5 billion. The uncertainty is so massive that Stellantis actually pulled their 2025 financial guidance because of it. You just can't forecast accurately when trade rules are up in the air like that.
Wow. Pulling guidance is serious. That really underscores the uncertainty. And tariffs aren't the only external headache, right? Supply chains.
Definitely. China's dominance over rare earth elements, critical for EV motors and electronics, is a vulnerability for everyone. Yeah, China granted some temporary 6-month export licenses recently, but that's just kicking the can down the road. Stellantis is trying to get ahead of it, looking at alternatives like the Magbarus consortium in Brazil to develop a non-Chinese supply chain for magnets, but it highlights a global risk.
And then there's the shifting sands of regulation here in the U.S.
Exactly. You've got the potential reset of the CAFE fuel economy standards. Stellantis actually supports that, calls the current rules out of sync with market reality. But changes there could really shake up the market for regulatory credits, which has been quite lucrative for some. Then you have California losing its waiver to set super aggressive EV mandates. That kind of policy back and forth, that whipsaw, makes it incredibly hard for automakers to make long-term, multi-billion-dollar investment decisions. They need stability and broader economics. Well, EU car sales grew just a bit in May, but the mix shifted dramatically. BEVs up 25%, plug-in hybrids up nearly 47%, reinforces their multi-energy strategy. But high interest rates everywhere, still a major drag on consumer spending.
Okay, let's bring it back inside the company. Operational fundamentals, the product pipeline. This is where the fixable part really comes into play. How's their financial health look today, considering all this?
Well, fundamentally, the balance sheet is still remarkably strong. That's a key point. End of 2024, they had $49.5 billion in available industrial liquidity, and importantly, more cash than debt.
Right.
$35.4 billion cash versus $34.7 billion debt. That financial muscle gives them a real cushion. Room to maneuver, invest, weather storms. It's a major underlying strength.
Okay, strong foundation. But investors haven't felt that strength recently, have they?
No, absolutely not. That's 70% profit collapse in 2024 to $5.5 billion. That hurt. The reduced dividend, that hurt too. And maybe the most telling thing, the stock price has basically gone nowhere over the 5 years since the Fiat Chrysler PSA merger happened. That suggests all that promised value, the synergies. It just hasn't really materialized for shareholders yet. Flat performance is a clear sign of, well, unfulfilled potential.
So let's nail down those specific fixable operational problems Filosa needs to tackle. What are the big ones?
Number one, probably quality control. You hear it anecdotally, especially around Ram and Jeep. Complaints, reliability issues that damages brand loyalty badly. Number two, inventory. Dealers were just drowning in unsold cars through much of 2024. Wrong mix of vehicles, prices weren't competitive enough. That clogged everything up. And number three, those product delays. The Ram 1500 Ram Charger, the range extender electric truck everyone's waiting for, pushed back to early 2026 now. And the full battery electric Ram 1500 RVV delayed even further, summer 2027, likely as a 2028 model. That's frustrating for dealers and customers eager for those new models.
Okay, quality, inventory, delays. How's the product pipeline looking now? Is it geared towards fixing this? Are they being pragmatic or just pushing more new stuff?
It looks pretty pragmatic, actually. Take the decision to bring back the old 5.7-liter AHEMI V8 engine for the 2026 Ram 1500. That's not about future tech. That's about listening to dealers and customers right now, giving them what they want, boosting sales morale immediately, a smart, practical move. And they are bringing back those beloved names. An all-new Jeep Cherokee is confirmed for late 2025, a new midsize Dakota pickup plan for 2027. These are known winners that should help rebuild volume and dealer trust.
So leaning into the classics, but not totally abandoning the future, right? I saw something about a Chrysler Halcyon concept.
Exactly. They're trying to balance. The Halcyon EV concept looks futuristic, 800-volt architecture, level 3 autonomy. Keeps the innovation story alive. They've got other things too, like a specialized Jeep Wagoneer for command operations, Ram getting back into NASCAR, and importantly, they're investing in the nuts and bolts. A huge new $388 million parts distribution mega hub in Michigan, opening 2027, that's aimed squarely at fixing the Mopar parts network. Improving service, which is key for customer satisfaction, tackles those operational weaknesses. Okay, so let's try and pull all these threads together. The bull case for Stellantis, it really hinges on that deep undervaluation. PE below 5x. That's a huge potential margin of safety. You've got the new CEO, Filosa, seen as a credible catalyst, someone who knows the company and has the mandate to fix those self-inflicted wounds, quality inventory, dealer relations. You've got incredibly powerful brands underneath it all, Jeep and Ram especially. A pragmatic multi-energy strategy that doesn't bet the farm on just one tech. Smart, capital-light partnerships like Leapmotor. And it's all sitting on top of that rock-solid balance sheet, which allows them to return cash to shareholders even while they fix things. But then, the bear case. It's serious, too. Those external headwinds, especially the U.S. tariffs, huge, potentially unquantifiable risk right now. Could just wipe out profits. There's significant execution risk. Can Filosa really fix these deep-seated problems? Quality control issues can take years to truly root out. Rebuilding dealer trust also takes time. There's a real risk of long-term brand damage if they don't move fast enough. And the competition. It's just brutal out there, especially with the EV transition accelerating. So for you, the listener, trying to make sense of this, what should you watch? Key metrics, operationally. Keep an eye on U.S. dealer inventory levels. The target is to get below 330,000 units. Watch third-party quality scores, like the J.D. Power studies. And are they hitting those revised product launch dates? Ram Charger Q1 2026, Cherokee late 2025. Delays would be a bad sign, financially. Track their adjusted operating income margin. Guidance for 2025 is just mid-single digits. Need to see if they hit or exceed that. And industrial free cash flow guidance is just positive. How positive? Externally. Any real news, any resolution, or even just clarity on U.S. trade policy and those tariffs, that could be a massive catalyst one way or the other.
So, boiling it all down, what's the final thought for someone looking at Stellantis right now?
I'd say Stellantis NV is definitely a high-risk, high-reward situation. It feels best suited for patient investors, those with a real value-oriented mindset. You're essentially making a bet on Antonio Filosa, a bet that he can pull off a really complex operational turnaround in a tough environment. The path forward will almost certainly be volatile, bumpy, but the current valuation, it does seem to offer a significant margin of safety if they execute. And maybe, just maybe, any further stock weakness caused by those external factors like tariffs could actually be a buying opportunity, provided those internal metrics we talked about, inventory, quality, margins, start showing clear, undeniable improvement. It's definitely a compelling, if challenging, story to follow.
And that wraps up this deep dive. We really hope this detailed look helps you make sense of the complex picture at Stellantis. If you found this valuable, do us a favor, give us a like, and make sure you subscribe to the deep dive and hit that notification bell so you don't miss our next expert analysis. Until next time, keep digging.